Okay, real talk. Imagine you wake up tomorrow and just decide, nah, not paying my loan this month. Not because you're broke, because you're done. Now imagine 30 million people making that same call. Same morning, same energy. What goes down next is not what you think. Because this whole thing, it's not a story about riots in the streets or people losing their minds. It's a story about math. And honestly, math hits different than any chaos ever could. All right, peep this number, $490 billion. That's how much Americans owe on credit cards alone. Not mortgages, not student loans, not car payments, just credit cards. That's it. Now here's another one, 72%. That's how much of the entire US economy runs on regular people just out here buying stuff. 72 cents of every dollar keeping this whole machine alive comes from everyday folks picking things up off shelves, clicking checkout, swiping their cards, and most of those folks doing it on borrowed money. So when you hear some talking head on TV say the economy is crushing it, what they're really saying is people are out here spending, and when people are spending, they're almost always borrowing. And when they're borrowing, somebody on the other end of that deal is counting on getting paid back. The whole thing is a machine, and no cap, machines break. Let's get into exactly how. Before we go there, you gotta understand why people are paying these loans in the first place. Not like in a you made a promise, keep it kind of way. In a purely mechanical, how does this thing actually work kind of way? Because here's the thing most people don't know, and it's kind of wild when you first hear it. When a bank gives you a loan, it's not pulling money out of some vault somewhere. It's not like they had a pile of cash sitting there waiting for you. The bank basically creates that money the moment it lends it to you. That's not a conspiracy theory. That's just how it works. It's called fractional reserve banking, and the gist is this. Banks are only required to keep a fraction of their deposits on hand. The rest, they can lend out. So say you drop $10,000 in your account. The bank keeps maybe $1,000 in reserve, lends the other $9,000 to somebody else. That person deposits it somewhere. That bank keeps $900 and lends out $8,100. This keeps going and going. By the time it plays out across the whole system, your original $10,000 has turned into almost $100,000 floating around in the economy. That's called the money multiplier, and it sounds kind of cool until you realize it goes both ways. Back to our scenario. Tomorrow morning, 30 million people. 0 payments sent. First few hours? Nothing crazy. Banks have buffers. They have systems. You'll get a text, maybe a late fee. Life looks normal from the outside. End of week 1? That's when it starts getting spicy. Banks start flagging all these loans as non-performing. That's the technical term for a loan that's just sitting there dead, not generating any income. Healthy banks keep that number under 2%. During the 2008 crisis, it crept up to around 5%, and that was enough to almost take the whole system down. In our scenario, that number goes to 30–40% overnight. Now the bank is cooked. Because here's what most people don't realize. Those loans weren't just sitting on a shelf doing nothing. They were assets. The bank was using them as collateral to borrow its own money, to justify the deposits it was holding, to keep everything running. Take those assets away, and the bank's balance sheet doesn't slowly crumble. It caves in overnight. And that's where things get real. Here's something that'll low-key blow your mind. Banks don't just lend to people like you and me. Banks lend to each other. Like, constantly. Every single night. There's a whole market for this called the interbank lending market. Banks that have extra cash lying around lend it overnight to banks that need it. It runs on low rates, and it runs smooth. But the whole thing runs on one thing more than anything else. Trust. The second banks stop trusting each other, that market shuts down. Not slows down, shuts down. And when it shuts down, banks can't meet their reserve requirements. They can't process your withdrawals. They literally cannot open their doors. And this is not a hypothetical. This actually went down in 2008. Not because everybody decided to stop paying at once, but because enough sketchy loans had been piling up quietly for years, and then all blew up at the same time. The interbank market froze in days. The Fed had to throw hundreds of billions of dollars at the problem just to get banks talking to each other again. Now picture that same situation, but instead of building up slowly over years, it pops off in 72 hours. Day 3 of our scenario. The Federal Reserve is having an emergency all hands. The Fed's got moves, real ones. It can slash interest rates to 0. It can buy assets straight from banks and flood the system with cash. It can be the lender of last resort and basically co-sign for any bank that's about to go under. But here's the issue. All those tools, they're built for a confidence problem or a cash flow problem. They are not built for a situation where the loans are just gone and nobody's paying them back. Like you can throw a life preserver to someone drowning. But if the water is rising faster than they can grab it, the life preserver is just floating there, looking useless. The Fed starts buying everything in sight. Mortgage-backed securities, corporate bonds, programs with acronyms so long nobody remembers what they stand for. The Fed's balance sheet, which was sitting around $900 billion before 2008, ballooned to almost $9 trillion by 2022 across different rounds of crisis management. In our scenario, it'd need to go way past that. Way faster. Now, while all of this is going down inside the financial system, something else is quietly happening on the outside. Businesses start feeling it. Not all of them. Not on day 1. But the ones running on credit lines to cover payroll. The ones borrowing to stock up on inventory. The ones that operate month to month because their money comes in seasonal, but their bills show up all year. Think about it like this. A clothing brand borrows in January to buy fabric, run production, get the spring line ready. They pay that back in April when retailers buy the inventory. That's just normal business. But if the banking system is locked up and that January loan doesn't come through, no fabric, no production, no spring inventory. Stores can't restock. Customers show up and the shelves are looking bare. That's how a financial crisis crosses over into an economic crisis. It's not some dramatic moment. It's boring, honestly. It's just one supply chain after another quietly running out of the credit it needs to operate. A few weeks into our scenario, layoffs start dropping. Not because companies want to do it, because they straight up cannot make payroll without functioning credit lines. And people who just lost their jobs, you might clock, are even less likely to pay their loans than they were before. Now the spiral is locked in. All right, let's pump the brakes for a second on something that gets glossed over in these conversations. The people who built this system weren't clueless. Modern banking has been through it, refined over decades. There are regulations, capital requirements that force banks to hold buffers for exactly this kind of situation. Deposit insurance so regular people don't lose their savings if a bank goes belly up. Annual stress tests, where regulators basically try to break the banks in simulation to see if they survive. The system has guardrails, real ones. The uncomfortable question is whether those guardrails were built for the right kind of wreck. Because the situation we're talking about, sudden, synchronized, voluntary mass default. That's not in the stress test playbook. They run scenarios for recessions, housing crashes, pandemics, interest rate spikes. They do not run scenarios for 30 million people collectively deciding to peace out on their loan payments at the same time. Collective human decision-making is historically the most unpredictable variable in any economic model. Always has been. Now let's talk about what happens to the actual dollar. Because you can't have this conversation without going there. When bank assets collapse, so does the bank's ability to create new money. Remember that multiplier we talked about? It runs in reverse now. Loans disappear. Deposits disappear. The money supply starts shrinking. Economists call this deflation. Deflation sounds kind of chill at first. Prices drop. Things get cheaper. That sounds like a W, right? It's not. When prices are falling, people who still have money stop spending it. Why buy today what'll be cheaper next month? Businesses see demand falling off, so they cut prices more. Then they cut costs. Then they cut workers, which drops demand further. That's the deflationary spiral. Last time it fully played out was the 1930s. Unemployment hit 25% in the US. Industrial output dropped nearly in half. Banks failed by the thousands. It took an entire world war to jolt the economy back to life. Our scenario would kick that off faster and harder than anything since then. Here's the part that's kind of grimly funny if you sit with it. The people who'd be most motivated to stop paying their loans are almost always the people carrying the most debt relative to what they make. That's lower and middle-income households. People who borrowed because they had no other option, not because they were living lavishly. But those same people, they're the ones who get wrecked hardest when the fallout hits. Wealthy people can park their money in things that aren't tied to debt. Land, equity, commodities, assets that hold value even while the financial system is going haywire. They can sit out a banking crisis with limited damage if they've been smart about it. The person living check to check has no such option. They need a functioning economy. They need their job. They need banks to be open. They need the credit flowing that keeps businesses running and shelves stocked. The system's kind of messed up in that way. The people with the most legitimate reason to be fed up with debt are exactly the ones who can least afford to act on it collectively. So what do governments actually do when defaults start stacking up? History's got receipts. In 2010, Iceland did something that nobody expected. After its banking system got obliterated during the global financial crisis, Iceland did not do the standard bailout playbook. It let its major banks fail. It made foreign creditors eat the losses. It threw up capital controls. It arrested banking executives. The whole financial world said Iceland was cooked, called it reckless, irresponsible, straight up suicidal for their economy. 10 years later, Iceland had put up one of the strongest recoveries of any country that got hit by that crisis. Then, look at Greece, which went the opposite route. Took massive bailouts. In exchange, brutal austerity for years. Pension cuts, wage cuts, tax hikes, youth unemployment at 60%. A decade of economic growth basically wiped out. The lesson isn't that defaults are the move. The lesson is that who ends up holding the bag matters more than almost anything else. And in most cases, governments tend to arrange it, so regular people are holding more of it than they should be. There's one more layer to this that barely gets talked about. Sovereign debt, the money governments owe. When the private sector implodes and the banking system locks up, governments step in to stabilize things. And how do they do that? They borrow. Big. They borrow to bail out banks, fund unemployment benefits, run stimulus. Basically keep civilization operational while the private sector tries to find its feet. The US national debt was around $5 trillion before 2008. Right now, it's north of $35 trillion. Not all of that jump is crisis response, but a significant cut of it is. So here's the wild thing hiding inside this whole thought experiment. When everyone stops paying their loans and the system breaks, the government steps in and borrows more on everyone's behalf. The private debt doesn't vanish. It just gets transformed into public debt. The obligation shifts from individuals to the collective. From you personally to you through your taxes, your public services, your kids' financial future. The debt doesn't disappear. It just changes hands. And here's the thing. This scenario isn't entirely hypothetical. Argentina has defaulted on its sovereign debt 9 times. 9. Most recently in 2020. Every time it's chaos. Currency collapses, hyperinflation, bank runs, unemployment spikes. Regular Argentinians who had no say in any of the decisions that led there get absolutely smoked. And then, slowly, things restructure. Creditors who refuse to negotiate realize they have no play left. The country gets back into credit markets on new terms. Life picks back up. Not without scars, not without real, lasting damage to institutions and to people's faith in the system. But it picks back up. That tells us something worth holding on to. The financial system isn't fragile like a bone that snaps clean. It's more like a body that can take serious damage, recover, adapt, keep going. But every time it recovers, it's rebuilding on a slightly shakier foundation. More debt, more complexity, more interdependence, more potential for the next hit to be worse than the last one. Let's land this. The reason this thought experiment is worth running isn't because 30 million people are actually about to ghost their loan payments tomorrow. They're not. It's worth running because the system it exposes is one that most people are already knee-deep in without really understanding what they're in. You borrow. The bank creates money. The money multiplies. The economy runs. You work to pay back money that only existed because you signed a document. And if too many people can't keep paying, the whole chain reverses, and the damage falls on the people who were least equipped to absorb it. This isn't a broken system. This is the system doing exactly what it was designed to do. The design is the thing worth actually examining. Because once you get it, once you understand that the modern economy is just an enormous web of promises stacked on top of promises, all of it running on a currency whose value depends entirely on everyone choosing to keep believing in those promises, you start to look at debt differently. Not as money you borrowed and owe back. As a position you hold inside a much larger system. A system that's incredibly resilient, right up until it isn't. Here's the question that nobody has a clean answer to. We built an economy that requires people to keep borrowing just to keep functioning. Individuals borrow to spend. Businesses borrow to operate. Governments borrow to stabilize. And all of it is sitting on the belief that tomorrow will generate enough value to justify what we borrowed today. That bet has paid off more often than not throughout history. That's the whole reason the system has survived and expanded for centuries. But a belief is not a law of nature. Somewhere in the gap between the debt that's been taken on and the growth that has to justify it, there's a number, a threshold, a point where the math stops working and the belief starts cracking. Nobody knows where that number is. Not the economists, not the central bankers, definitely not the governments. What they do know is that every tool deployed to manage past crises has added another layer of complexity to the system. Another promise on top of a promise. Another $1 trillion of intervention that handled the immediate problem while quietly making the next one harder to solve. So the real question isn't what happens if everyone stops paying their loans tomorrow. The real question is, what happens when the system that needs them to keep paying runs out of ways to make that possible? Nobody's really sure. And that, way more than any loan default, is the thing worth losing sleep over.